This is Retire Hour.
Welcome into Retire Hour, the weekly show that keeps you up to date on the ever-changing landscape that is retirement. I'm Joshua Cicora, your host for this week. We've got a full show for you, so stay tuned for the back half of the episode where we talk to healthcare, estate planning, and tax advisors about what's going on in each of their industries. But right now, I've got Kimberly Sixkiller in studio with me. Kim, I won't need long-term care, right? I mean, I'm pretty healthy.
Unfortunately, the hard truth is, while you may be healthy now, over 70% of us have that chance of turning 65 and needing long-term care later in life. So when many people think, I shouldn't worry about this now, with long-term care, if you plan for it now, you can save money and help remove that burden for your loved ones of, if something happens sooner, what am I going to do?
Well, that's their problem, right?
Well, your wife might not agree with that, but you could go that route.
Probably not. So then, I mean, what happens if I don't make a plan?
So, the burden of not having a plan, in addition to the financial strain that it can place, it's just a minefield of financial and emotional pitfalls, is you may not have a place to go. So there is a huge shortage of nursing home beds nationwide, and so there are waiting lists. And while your family may find you the location to place you, it may not be ideal, right? So the smaller our options, the less likely we're going to get the choice that we prefer. So.
Yeah. I can't imagine if I need nursing care, I want to go to a place that only sort of that deals with what I need or doesn't cover it at all, and then I'm not getting the care I have to have.
Or maybe just doesn't have the quality of care that your family and your loved ones would likely prefer you have. And so what that kind of gets into is people want to be able to stay at home, right? And most people say, I would prefer to spend my time at home if I can. And then if you haven't planned for it, you have a huge burden that you're placing on your loved ones from a caregiver perspective, right? So 60% of caregivers, on average, end up having to either switch their jobs or completely quit because they need to take care of their loved ones. And if you haven't planned for that financially, I mean, imagine what that means to just cut half the salary and half of the household expense doesn't go away. It actually is going to increase because now maybe we need to put in ramps or we need somebody to come in and help with changing certain medical equipment.
Right. I mean, I think carrying that one step further, if I need nursing care, I'm not working before that point.
Right.
And then if my wife was working and she has to quit to take care of me, there goes all of our earned income in the household. And hopefully I've got the nest egg there to support it. But you were talking about how expensive nursing care is.
Yeah, nursing care, the average nationwide is about $10,000 a year, right? And so $10,000 a month. We wish it was a year.
Yeah.
$10,000 a month. So when you think about that, right, if that's an unplanned cost, then now we go, okay, well, maybe we're going to cut back and we're just going to keep them at home because we have that ability. They don't quite have a situation that they need to go into full-time care. Well, even if you're going to keep someone at home and help them at home, the average cost to have a caregiver come in is $34 an hour.
Yikes.
So if you have them come in to do a few things, 5 days a week, wife can come home on the weekends, kind of take care of things. Mm-hmm. I mean, those numbers stack up fast.
They do. And I mean, if you're talking about having a financial burden, I could see people where there's a point that maybe someone should go into nursing care. They can't afford it. So then they stay at home so that they're not getting the care they need. And then what we haven't talked about at all is how inflation plays into that, right? Medical inflation's worse than the broad economy rate of inflation. So I can't imagine that $10,000 a month stays there for very long.
Absolutely. And so what we work with when we're talking to clients and prospects here at Market Advisory Group is, look, we're not talking about creating a separate plan for the long-term care needs. What we're saying is look at your whole financial package and really consider that your health is a large piece. It's one of the top 3 concerns people have as they age, right, is their health and that health care.
Sure.
So how do we plug that gap in the boat, right? How do we make sure that we are plugging that hole from the water, getting in and saying, we still have Social Security, hopefully. Mm-hmm. Hopefully it's still there when we all get there, right? Knock on wood on that. And we have a pension or something different coming in. But what if we could take money that we have right now, sitting in savings, maybe it's in an IRA, maybe it's in a 401k, and we can move that money over here to an account where it's still saving, but it brings about a long-term care assistance plan. So you've got different riders or different pieces that attach to it and say, okay, should you need to use nursing care or should you need in-home care, now we have availability to utilize some extra money, some extra income streams to help with that.
Right. And if that's in your future, you're going to spend those dollars on medical care anyway.
Absolutely.
So this lets you set up something to come alongside you and help you afford those things that your ordinary retirement savings wouldn't be there to cover.
Yes. And then we're seeing a trend nationwide, and I know you and I have talked about this before. There are states that are starting to mandate some kind of long-term care planning. So Washington has that mandate in place. It's been in place for over a year, couple years actually. And so if you don't have it, think of it kind of like when Obamacare and ACA came into place, and it was like, we're going to make you put it into place. And those plans are pretty expensive and not as great as they could be. And there are more and more states, kind of Google that in your state and see that are nationwide saying there has to be an option, there has to be a plan, because a large percentage, the majority of people who are on long-term care for more than 2 years, they get into a Medicaid situation.
Yep.
And now that cost is bleeding from the state.
One last quick question. Obviously, you can't be signing up for this like right before you need to go to nursing care, right? I need nursing care next week, so let's sign up for the long-term care policy.
Right.
When is the sweet spot for people to sign up for that?
So it's a little controversial for people to think about, but I say the sweet spot to really start thinking about your long-term care is in your early 40s. And the reason for that is you have gotten to a point, hopefully, and in most cases, where you've kind of planned, your kids are a little more grown, we're starting to put money in savings, and you're in that peak of health in most cases. So we can get long-term care options that can be more affordable for the long term, but at least be planning about it before age 70 if possible. But you can get long-term care all the way up until age 85 in some states.
You know, people, times are getting turbulent. What are you doing to protect your nest egg? Is there even anything you can do to protect against these kind of issues? Well, all it takes to find out is a 15-minute call. If you'd like to set up your 15-minute introductory phone call to see what might be missing in your retirement plans, reach out right now at 833-MAG-REPORT. That's 833-624-7376. Or go on over to our website, retirehour.com. There you can watch past episodes, submit a question, or schedule that 15-minute call with the Market Advisory Group team. Stay tuned. When we come back, we'll be talking with financial advisor Danny Goolsby about Social Security, and we'll be right back. Well, welcome back into Retire Hour. We've got Danny Goolsby coming in from our West Wichita office. Danny, how does the process go for claiming Social Security?
So advising on when to take Social Security can be a whole lot more daunting than people realize. When it comes to retirement planning, financial advisors, we want to put together a plan on, where the income's going to come from retirement. But the base of that usually is going to be Social Security for most of us. But most of us are uncertain about how to take Social Security, when to take it, what are my options to take. And there's a study out that recently that said that there's a gap between men and women in confidence as far as what's related to retirement. So men happen to be a little bit more confident going into retirement than women do, according to this study. This study said that 1 in 4 women feel that they're on the wrong track for retirement, compared to just 15%, according to the National Retirement Institute survey. According to this survey, though, that women are more pessimistic about Social Security being around it. And I know you and Kim talked in the previous segment about Social Security, whether it be around talking about long-term care. Personally, I don't know if long-term or Social Security is going to be there or not. No one can predict the future for any degree of accuracy, but I can tell you that I believe personally that Social Security is always going to be around for 3 main reasons. Number 1, it's a tax, and it can always go up. They can always raise taxes, that is. Number 2 is they can always print more money, and it seems like Uncle Sam is happy to print more money. But number 3, it's the pay-as-you-go system. People who are working in the workforce right now are paying into the system as people who are drawing benefits are taking them out. So it's a pay-as-you-go system. but it's also not disputed anywhere. I would think in media that Social Security is going to have to be updated. Something's going to have to happen to Social Security to upshore it or to strengthen it for future retirees. Does it make any sense that my full retirement age of Social Security is the same as my children or even my grandchildren? My grandchildren have the same retirement age as I do, my full retirement age. So Social Security is going to have to do something. But there's also another study done that says that most of us take our Social Security to our detriment when it comes to creating an income plan. And when I say it that way, that 96% of people don't optimize their Social Security, so they're missing out on something. This study said that about $111,000 of missed benefits are missed because people take their Social Security benefits at the wrong time. So today, in this segment, I want to talk a little bit about Social Security and how to get the most out of it. We as financial advisors, we as tax advisors, Joshua, you're a tax advisor. We as a full service, holistic planning service for our clients, we want to bring different professionals to the table that can help with this process. So Josh, let me throw you a question out there. So by trade, you are an accountant. Would that be fair?
That is fair.
That's fair. Okay. But you have gone further than just your higher education, if you will, and you've gotten some other credentials. What are those credentials?
Besides being a certified public accountant, like you were saying, I'm also a certified tax coach, which works with people to minimize their long-term tax burden.
Okay, so you've gone higher education to solidify and learn things about your trade, and we benefit. I say we, our clients benefit from that enormously by your knowledge. One of the things that we want to do with our clients is show other things that they can benefit as well. When it comes to the maze that is Social Security and when to file for that, we also have another team, a part of our team, and that would be a registered Social Security analyst. So we have those people that we can pull into the room. And when it comes to when to file for Social Security and what does that look like, whether you're a married person, if you're married, you may be able to collect up to 1/2 of your Social Security's, your spouse's Social Security benefit. That won't affect your spouse's checks. But if you're divorced and you find yourself divorced and trying to figure out how to have that income plan, if you're divorced and you're 82 years or older, you may be able to qualify for Social Security benefits from your ex-spouse, depending on your circumstances. So there are a lot of different things that can come into play. When you're widowed, what happens to your Social Security benefits if you're widowed? In other words, what happens then? I know that you and Kim were talking last segment about when one spouse dies in a household, that the income in the household goes down. Typically, what happens though when they lose a Social Security check, if a spouse should die? What happens, Joshua, when in the tax part of that whole equation?
So the surviving spouse is facing switching over to a single filing status, which means half the standard deduction, the tax brackets get cut in half in terms of the amount of income they cover. It's not a great situation. So essentially, your income is going down as a widow, but your taxes are going up, likely. And that's interesting. How can I pay more taxes on less income? But that's where we find ourselves. So again, if you find yourself trying to figure out the retirement maze income and how do I plan for myself, plan for me and my spouse, what's the best option for us to take? I would encourage you to try to rely on a team, whether that's a team like Joshua that can help you navigate the maze, but also a team that can help you analyze your Social Security options going forward. Sometimes it's not just as straightforward as you might think of, where I just go down to the Social Security office and I file for my benefits to begin. No, you may be losing out on some benefits by not understanding the Social Security code, tax code. So, if you're like Albert Einstein said that the hardest thing for him to understand was the American tax code. Well, that's the same thing as it relates to Social Security. So that would be my encouragement for people today: is pull on these professionals on our team, whether it's Joshua and the tax side of things, or whether it's another team member like Taylor, for example, who is a registered Social Security analyst, and she can help you navigate these things. Yeah, absolutely. It's great to have that team to help us figure it out. Social Security can be a really tough thing to figure out. And if you want to find out there's ways to get what you can for the most, All it takes is a 15-minute call to start that out. To set up that 15-minute introductory phone call, reach out right now. 833-MAG-REPORT. That's 833-624-7376. Or go on over to our website, retirehour.com. There you can watch past episodes, submit a question, or schedule that 15-minute call with the Market Advisor Group team. Now, when we come back, we'll be talking to Jonathan McCoy about losing a spouse. Stay tuned. Welcome back into Retire Hour. We've got Jonathan McCoy in studio with us. Jonathan, we were just closing out Danny's segment where he was talking about Social Security and losing a spouse.
Right.
You know, losing a spouse is tough. And I can't imagine having to think about retirement issues while you're dealing with all that emotional trauma that goes along with it.
Well, I think that, a big focus of what we wanted to talk about today is both before and after losing a spouse, right? We were just chatting before the segment, you look up online, what are these things to consider when preparing for or after having lost a spouse? And you go through, and we think we're becoming more and more reliant on things like AI and the internet, but even you search, and at the end of the recommendations here, seek professional advice. Consider consulting with a financial advisor, estate planning attorney, or tax professional to help navigate these complexities. This is direct off the interwebs, right?
If only there was a place where people could find all those things together.
If only. I mean, it turns into a little bit of a shameless plug when we go down that road, but when we think about things, there are lots of statistics out there in terms of how the loss of a spouse might affect things like your household expenses. There's on average a 20 to 25% reduction in cost, but sometimes your household income could be cut by as much as half, depending on what happens, like what Danny was touching on in terms of the loss of a Social Security check, potential loss of a pension or reduction of a pension, especially for folks that are married to retired military. A lot of times those survivor's benefits are only set at 50% of what that original pension payout was going to be. Or VA disability benefits. We've got some specialists here in the office that can talk in an educated fashion around that. Those VA disability benefits completely go away at the end of your life. So significant changes to income are a very difficult thing to account for after the fact, after we've lost a spouse.
Sure.
And normally these things, unfortunately, are impacting people later in life, right? So we have things like, from a tax perspective, we talk a lot about required minimum distributions. Well, what happens upon the potential combining of those household retirement accounts, right, past age 73? You could talk a little bit about that from a tax perspective.
Yeah, I mean, generally the surviving spouse takes over the account. The required distribution doesn't go away. It just rekeys to whatever that surviving spouse's age is.
Right.
And so that means that the income's going to stay there, which is great because you probably need the income, but also bad because now it's flowing through your tax return. And like we were just talking with Danny, you go from that joint filing status to the single filing status. Pretty much assume your taxes double at that point.
And to take a step back, because I think a lot of people start to gloss over, it's like, whoa, we're listening to this on the radio. It's hard to keep up with you guys.
Yeah.
We're talking about those minimum distributions you're required to take out of your retirement accounts. At the current ages, past age 73, if you were born 1960 or later, that's going to be age 75. So if your spouse passes away when you're around age 80, now you have sort of this same level or dual amount of those required taxable distributions from your household IRAs showing up under just your Social Security number as a single tax filer. These are conversations that we're finding most people aren't having or can't have with their current financial advisor, and aren't knowing enough about what to ask. We always talk about you don't know what you don't know. So how do we know what questions to ask? When I talk to folks about what are their tax management conversations or tax planning conversations like with their financial advisors, what do you think the most common response I get is?
There weren't any.
There weren't any.
Yeah.
Never brought it up. Maybe that's on us, right? Well, the folks that come to us at Market Advisory Group for our help as professionals, to Danny's point, having the right licensures, having the right education, have the right specialities, and that's why we understand as financial advisors, we can't do it all on our own. That's why we have this team working together for our clients' benefit. But us as trained professionals know more about what the folks that are 15, 20, 25 years older than you have gone through, when they've lost a spouse, when they've had to turn on those required minimum distributions. And it's our job in this consultation process, whether you set up that one-on-one in-person meeting in one of our offices between our various metro areas that we work in, or setting up that complimentary 15-minute phone call, we're addressing those questions up front for you because we recognize that a lot of times you're not going to know what question to ask. Now, you're going to have your top of mind concerns around when should I file for my Social Security? What are the tax implications? You know, is the IRS really just going to rake a lot of money out of my retirement account? How much of this money is actually mine? You know, how is this going to impact my kids if something happens? These are all common concerns that we know most people are bringing to the table when we sit down for that first complimentary meeting. Yeah. And really, I think the key point is understanding that when you sign up for a 15-minute phone call or our in-person consultation service, you're not going to be responsible for having to come up with all these questions. Our job and our system is built around understanding your concerns first and being able to dig deeper into what those concerns are, how those things are going to be impacting you, your family, your lifestyle, and using those things and injecting some professional input to help give guidance on what strategies can be put in place to manage and mitigate the risks in those different problem areas.
Right. Like you were saying, when people get into these situations, they oftentimes don't even know what questions to ask.
Right.
And so we've helped people through these situations before, and we've got the professional expertise to know how to talk about these sort of things.
Right.
So then we bring that all to bear when we meet with folks, so then we can answer their questions, but then start talking about the things that didn't even know to talk about.
Yeah. So think about this for the listeners out there, for the viewers on Cox 22 or any of the other channels that we've got. So has your financial advisor brought to your attention the tax ramifications that will occur if and when you lose a spouse? Or if you've got a spouse, or even if you're unmarried, right? If you leave these retirement accounts to your kids, what's the tax impact going to be on them? Oftentimes we're finding those conversations aren't being had, and a lot of people are out there trying to do their own online research, Googling, you know, and some people just don't even know to think about it. And that's not to say that it's not a concern, but sometimes until these things are brought more directly to our attention, we don't know to think about it until it's too late. And, you know, the time to plan for all of these financial impacts is not just after you've lost a spouse or right when your kids are having to handle and manage the tax ramifications on their inheritance. It's really ahead of time. That's why we welcome folks to come in for these consultations.
Right. You know, Gerald, one of our estate planning attorneys, likes to say that emergency planning is really tough because there's not a lot of options.
Right.
And that's not just true about estate planning, but that's also true about the financial planning, the tax planning. All these things work best when they're planned out
just
in
like
advance.
Healthcare, right? It's hard to think about that extra mile you should have run when you're already in the ambulance after having some sort of cardiovascular event. The time to prepare is now. It's that constant maintenance and upkeep ahead of time.
Right. And everyone out there listening, this is why it takes a team working together to make these things happen. These things can fall through the cracks if you aren't careful. If you don't have a full team working together for you, just reach out right now. 833-MAG-REPORT. That's 833-624-7376. Or go on over to our website, retirehour.com. There you can watch past episodes, submit a question, or schedule that 15-minute call with the Market Advisory Group team. Well, stay tuned. When we come back, we'll be talking with Trey Bassa about Medicare, and we'll be right back. Welcome back into Retire Hour. I've got Trey Bassa with us today, health insurance advisor with Market Medicare Advisors. Now, Trey, I know most everybody knows Medicare, you sign up at 65, but there can be reasons and situations where people don't sign up at 65. Maybe it's on purpose. Maybe it's oversight and an accident. Maybe talk us through a little bit about why people might sign up outside of the accidents and what happens in those situations.
One of the more common things that we run into is people wanting to work past 65. They want to get to their full retirement age. And when they do that, there's a couple of extra hoops that they have to do with their health insurance at work. But they don't have to do anything when they turn 65. They don't have to sign up for Medicare. Part A is usually advised. Part B is not necessary. And that's the one that has the premium. And that one can cause some issues with like Social Security down the road if that were in the cards for you. But back to signing up past 65. There are two forms that folks have to fill out in order to prove that they've had what we call creditable coverage between 65 and whenever they retire, whenever they actually sign up for Part B. Those forms are going to be from you and in part from work, proving that you've had credible insurance. Somebody at HR is going to sign a form, date it, vouching that, yes, Joe had creditable coverage between 65 and 67. So he's good to go. Sign up for Part B, no late enrollment penalty.
Easy peasy. That part sounds good.
Yes.
What happens when it was an accident?
When signing up for Medicare was an accident?
Late. When you sign up late.
Unfortunately, that's where it gets a little tough. Signing up late, and this is why we ask people to come in months in advance, set up a time frame, and get some stuff figured out before it becomes an accident. But if you sign up late, that paperwork is then used to assess the penalty, the late enrollment penalty. Perhaps there is a gap between 65 and 66 when you didn't have a job, but you pick something back up at 66 to 67. There's a year where you didn't have creditable coverage, and that can cause you to pay, get a little choked up. It can cause you to pay a little bit more in Part B and Part D for not having that level of creditable coverage. And there's going to be a lot of different rules to what counts as creditable coverage. I've talked in previous episodes about the size of a business and how old you are and what is required by individual states to have when you turn 65, like a small business versus just a regular larger business, and levels of disability and levels of coverage and all of that fun stuff. That's a lot for an individual to consider.
So let me make sure I understand here. I'm kind of going off the cuff a little bit. It is possible for someone to be working past 65, have health insurance through their employer, but because of the unique facts and circumstances, the health insurance that they're using does not count as creditable coverage.
Yes. Most notably, folks who are like self-employed, run their own small business. That's probably the most common thing that I run into. They have to hop onto Medicare at 65, but not every small business owner knows that.
Interesting.
So when they turn 65, they think that they can continue their workplace insurance with their small business because it's their business, it's their insurance, they run the whole show. But unfortunately, I've had a couple of clients come in months past their 65th birthday when it's too late, and we do have to account for some sort of penalty.
And just out of curiosity, how big of a penalty are we talking about here? I mean, are we tens of dollars a month, hundreds of dollars a month?
For prescription drugs, that prescription drug plan, it is 1% of the national average cost of prescription drug plans. For every full month, you go without creditable coverage.
Ooh, that 1% is not a huge number, but if you waited 5 years, maybe you were running a small business like you said, you waited 5 years, that's 60 months.
Yep.
That sure can be expensive.
I think last year the average was 40 cents a month. But you impact that out for 5 years, all of a sudden, Mr. CPA.
Yikes, it gets expensive.
It adds up.
But now, at what point do the penalties end?
When you sign up. When you sign up for a creditable plan.
No, sorry. When do you have to stop? When do you get out of the penalty? Are you on Medicare for 5 years and then you get off out of the penalty?
That Part D prescription drug plan does not have a limit. It is a lifetime penalty.
Dang. Yikes, that sure sounds expensive. Extra expensive.
It adds up.
And then I assume on Part B, it's a similar scenario?
Yes, but you have a much greater time frame. It's actually for every full year that you aren't on Part B when you should have been, essentially.
Which kind of makes sense with how crazy prescription drug prices are. I mean, we hear about that in the news all the time. It would make sense why that penalty would probably be a little more severe, like you were laying out.
Now you have to worry about your timeline, make sure you're getting things done at the appropriate time. Not to mention, if you don't, there's these penalties that add up. And then, of course, there's just like the consistent reviews that we do with folks, making sure that you're on the right plans, making sure that you're filing your taxes. Can't forget about good old Aunt Irma Always lurking.
That's right. That's right. And so that's where it's great having that team that works together. So together we can help people with things like when their income might impact their Medicare premiums.
Yeah. At the end of the year, it's too late to make any modifications, right? The tax year's already over. So when I sit down with folks in October, November, and the beginning of December, I am talking to them about their taxes. I'm saying, hey, where are you at with this year? What is this going to affect in the future? IRMA's a 2-year look-back period.
Yeah. And, they're talking about new tax bills in Washington. And with the new administration, there are certainly big changes coming to the Medicare system. If you don't have someone there to walk you through these things, through these changes, it might be time to reach out. Sometimes all it takes is a 15-minute call to see what might be missing from your retirement plans. And if you'd like to set up that 15-minute introductory phone call, reach out right now, 833-MAG-REPORT. That's 833-624-7376. Or go on over to our website, retirehour.com. There you can watch past episodes, submit a question, schedule that 15-minute call with the Market Advisor Group team. Well, stay tuned. When we come back, we'll be talking with Gerald Eidelman about embracing the unknown. We'll be right back. Welcome back into Retire Hour. With me in studio, I've got Gerald Eidelman, founder of Eidelman Law Firm. Gerald, what are we talking about today?
Well, today I want to talk about a little bit of what-if situations that people are not planning for because they think they're outside of the realm of possibility.
Okay.
So a lot of times people get advice to set up a estate plan that is quote-unquote simple, and some people do it to save money, only to find out that the what-if situations can come up and they're not prepared, or at least their estate plan is not prepared to handle such a situation to help their children or grandchildren. Just to give you an idea, a lot of people do will-based plans, and will-based plans is better than having nothing.
Sure.
Because now we know where your assets you want them to go. Mm-hmm. But that's all it will pretty much does, is to transfer assets to whomever you decide. It is not effective in terms of protecting, let's say, you leave money for your grandchildren, and one of your children develops some form of disability. Well, the will is not equipped to deal with that situation. Yes, we can put language in a will, but if we start putting everything in the will, we got to trust. And
right.
So, most people, if they look at their will, it's probably a few pages, but there's so much contingency problems that can arise. Taxes, unknown. The special needs is one of the largest situations, because you just don't know by the time you die what situation your kids might be. They may be sick and receiving help from the government, and you leave them money and you cut them off altogether. So in a trust, we can account for that. Or let's say one of your children passes away before you do, and the money goes to their children. Well, their children might be underage, or 18 or 20, 21, and that would entitle them to get the money right away. Do you want to have your grandchildren have all the money you left, assuming it's a significant amount?
Yeah.
To an 18 or 21-year-old.
There's no problems there.
That's right.
Nothing could go wrong.
I can't imagine anything that could go wrong. But that's the whole point. Is in a trust, we can account for that. We can say what happens if the person is below a certain age. How do we want to distribute that money over the long term? A will, like I said, it just transfers assets and it's done. It does not control the future generally. The trust can last at least 90 years and can be open, and it can be used for a lot of different things. Another contingency situation that might happen is one of your kids gets divorced. Well, if you left it in the will and just said give this much to X, the money would be completely transferred to their child. Now, inheritance money is not included in a marital dissolution. But the problem is that people tend to commingle money between their inheritance, their personal, their spouses, and before you know it, that money has turned into a marital asset that has to be divided. With a trust, we can hold that money back. We provide protections in case of a marital dissolution. And we say basically that the beneficiary can receive money, but money stops when there is a marital dissolution, and we forbid the trustee from paying money out for that purpose. By keeping the money in the trust, is segregated, is not subject to a marital division.
So correct me if I'm wrong in how I think about this. A will is a one-time you saying what happens from beyond the grave.
Right.
A trust lets you keep saying things from beyond the grave as the situation may change between the time the document's written, the time you pass, and it sets up different contingencies for how different things might play out and lets you set up those protections in an ongoing fashion, whereas that will, it's one shot and whatever happens, happens.
Correct. That you're exactly right. A will is supposed to, be distribution instrument in general.
Right.
I mean, sometimes, if you have minors, it might include, guardianship or things like that. But the primary function of the will is to transfer assets. And we don't want to just be transferring assets without taking into account potential life situations.
Right. Like we started off the segment, it's all about embracing the unknown, right?
That's right.
So for those of you listening at home, you never know what's going to happen. You don't want to leave things to chance with your estate, especially because you won't be here to fix issues that may pop up. So if you'd like to set up a 15-minute introductory phone call just to see what there might be out there, give us a call. Reach out to us right now at 833-624 report. That's 833-624-7376. Or go on over to our website, retirehour.com. There, you can watch past episodes, submit a question, or schedule that 15-minute call with the Market Advisory Group team. Well, stay tuned. When we come back, we'll be talking with Taylor Bevan about some tax forms you might be getting in the mail right now. And we'll be right back after this. Welcome back into Retire Hour. To round out our show, we've got Taylor Bevan in studio with me. Talk about taxes. Taylor, why are people getting tax form in the mail now? It's like June. Tax season's done.
Right. We're well past the April 15th deadline. Most people have already filed their returns by now, and all of a sudden they receive this very important looking form in the mail from their financial institution. So then they call us up and are questioning if we need to do an amendment. That form is the 5498, and that really is more informational. It holds information about your retirement accounts. Did you do a rollover from one account to another? Did you maybe make a contribution to that account throughout the year? And that right there is why people are receiving these so late. You can actually make a contribution for the prior year in the current year as long as you do it before the April 15th deadline and have your return timely filed.
So then that makes sense then. You can make contributions up to April 15th, so they can't possibly send these forms out at the end of the year with all the other tax forms. Right. So they have to come out after tax season.
Correct.
what are some of the other things that this mysterious late coming form might tell us?
So another pretty important bit of information that it will have is it will show the fair market value of that account, and if there is any RMDs or when that RMD date is and what that amount might be.
Oh, so if people are 73 or older now, and here in a few years that'll change to 75, but if they're of that age, that form is going to tell them how much they have to pull out of their account.
Required minimum distribution. So it will calculate it on there for them and let them know the deadline for getting that taken out.
So then, so this form they're getting, it's important. It's an important tax form.
Yeah.
But it's not an important tax form for their tax return.
Not technically, unless they didn't tell their financial advisor that they went and made that contribution.
Oh, fair enough.
It could be, but no. Typically, you won't need to worry about that information as long as you've already discussed any rollovers, contributions, or other things with your tax professional prior to filing your return.
So let's say people have different retirement accounts, all these different places, right? They're going to get these, assuming they're tax deferred IRAs of whatever flavor, they're going to get all these 5498s in the mail. And let's say they're over the age of 73, it's going to tell them what the required distribution is.
Right.
Now, you already know this as a tax professional, but they don't have to take that amount out of each account. They can take it all out of one account or slice it up however they'd like. The key here, though, is that unless they're working with somebody who can manage all those things for them, it's on the taxpayer, the account owner, to know how much to take out and when to make sure that all those required distributions are met. And so this is a place where Matt Goolsby, one of the financial advisors, will often talk about how our retirement system is broken because people are retiring to enjoy life. And it turns out they actually pick up a part-time job trying to manage all these different things, like, are they taking enough money out of their accounts to satisfy what Uncle Sam demands? Now, they're going to take out enough so that they satisfy their cash flow, right? I mean, everybody likes to make sure that dinner's on the table, but that may not be enough. We see time and time again where we get to the end of the year and we have to tell people to take more out of their accounts, not necessarily because they want to, but because they have to keep Uncle Sam from assessing penalties.
Yeah.
Because while nobody likes paying taxes, absolutely nobody likes paying penalties, right? The tax you could have avoided.
Yeah.
And so that's where having someone who can help you manage all these things is so valuable. The other piece that comes in is as you get things like this that you don't know what they are and what they're for, it's great to have someone who's got your back that is aware of what's going on. And so when people started calling about getting these forms, we actually sent out a mass communication to all of our financial advising clients we work with saying, hey, you might be getting these in the mail. Here's what they are. Here's what they are for. And most importantly, no actions required on your part.
Yeah, it gives them a little bit of peace of mind that, they don't have to go and make big changes or, worry about their refund being taken back or owing more or anything like that. It's just an informational letter.
Nothing is scarier than the unknown. And when you get one of these forms or a surprise IRS letter in the mail, it becomes an unknown, and that's very scary. And like you were just saying, when you get something like this, your mind naturally goes to the worst situation. Yep. Oh, Uncle Sam's going to just take back the money they gave me, or I'm going to have to pay in more. I'm going to have to deal with some extra complication from the IRS. And so I know talking to our clients, they value the stress relief we give them, the peace of mind, because they know that we're here, we're keeping an eye on their situation, and we're available to talk to them whenever they need as these issues arise and they need a little extra support.
Yeah, always.
And, a lot of people are trying to go this at their own. And trying to manage it all on your own, Google's out there and you can search up whatever, but there's often nuance that can play into it. That's difficult for people to understand and see how that plays into whatever information they're getting out of the search results, or the Google, the search engines can send you down the wrong path because you either phrase the question wrong or there's some little piece that's missing there.
Yep.
And
or you use the wrong terminology. It's tricky for even the professionals who know what they're looking for to try to find the right answer sometimes, just because the amount of information.
Absolutely. Absolutely. Taxes are an inevitable part of life. We all have to pay taxes. But there are ways to mitigate how much you have to pay. And often it only takes a 15-minute call to see if you might be paying more than you have to. To make an appointment, just reach out right now, 833-MAG-REPORT. That's 833-624-7376. Or go on over to our website, retirehour.com. There you can watch past episodes, submit a question, or schedule that appointment with the Market Advisory Group team. Well, that's all the time we have for this week. I'm Joshua Cicora, thanking you for tuning in to Retire Hour. We'll see you here next week.
Unless otherwise indicated, all client names have been changed to protect their identities. Investment advisory services are offered through Foundations Investment Advisors LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns are not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. Legal services are offered by Edelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal or tax advice. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. The guest commentators featured in this show are not investment advisor representatives of Foundations and do not provide advisory services. Market Advisory Group does have several investment advisor representatives that can provide such services. This is not endorsed or affiliated with any U.S. government agency, the Social Security Administration, or associated with any federal Medicare program. We do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal/tax advisor to be sure a Roth IRA conversion fits into your planning strategies. All rights reserved.